Hey everyone, I apologize. I don't have my usual mic plugged in, so my audio quality is going to be a little bit worse than I would normally like for these videos, but I really wanted to get this done. Okay, so this video is going to focus on some very basic core concepts as it relates to trend analysis. The reason these core concepts are so important to understand is because once you grasp these concepts, it becomes much easier to understand, to answer the questions that seem to come up a lot, which is how do I enter a trade? Where do I find the best entry? Where do I place a stop? How do I set targets? So don't worry, those questions become very easy to answer. Again, once you grasp these core concepts, and they become even more powerful when you combine these concepts with the rules and guidelines laid out in the wave principle. Okay, so this isn't like an Elliott wave cycle or anything like that. This is just a standard uptrend. Now, what you'll notice here with this uptrend is that we have a series of higher highs and higher lows. I use the term pivot points as kind of a catch-all for these higher highs and higher lows, but I'm just going to point them out individually so we know exactly what I'm talking about and we can stay on the same page. So anytime the market turns, that is a pivot point. These are pivot lows. These are pivot highs. Together, these highs are advancing and these lows are advancing. And as those pivot points move together in one direction, we get a trend. It is literally impossible for an uptrend to occur without having a series of pivot points moving higher and higher in concert. So if we have something like this, let me start that drawing over. If we have something like this, that's fine. We've made a new high, but I can't call this a trend. We would still need to see a pullback, and we would still need to see a higher high. At this point, from a basic technical analysis standpoint, we can start saying that we have a series of higher highs and higher lows. So here's a low, here's a higher low, here's a high, here's a higher high. And you can easily flip this for a bear market, okay? Now, the reason this is important is because if we understand that to trade a trend, we need a series of pivot points moving together in concert, then we understand that once one of those pivot points is violated, that tells us something potentially meaningful, all right? So if prices turn and break, they break below this pivot point like this, the trend is in trouble. It's in trouble because we no longer have a series of uninterrupted higher highs and higher lows. So how can we use that information when it comes to placing stops? Well, one answer is pretty obvious. If we wanted to get out at the slightest sign that a trend is in trouble, then we would exit a trade for a controlled loss based on our predetermined position sizing if we take out this low. If we wanted to be a little bit more conservative and give the market more room to breathe, then we would wait until this low gets taken out, okay? At which point, this is what I would call critical support. Now on the YouTube channel, I do have a video distinguishing between key support and critical support levels. So you could reference that video if you want, might help you out in terms of connecting the dots with these concepts. Now similarly, if we need new highs, similarly in terms of picking entry points, if we violate a low on the way down and that puts an uptrend in jeopardy, well, what gives us confidence that an uptrend is still in play is if we continue to make new highs. So this is breakout trading, entering on a breakout of the prior high, at which point you can use the prior low as a potential stop. I'm not saying that these are the best ways to enter and exit trades. I'm just saying that if we understand these core concepts, then when we see price action in a real life price chart, it allows us to frame the current price action within the context of the larger underlying trend. Now in Elliott wave terms, if we have something like this, let's say this is a bullish impulse and we get an ABC zigzag. One common point of entry that a lot of Elliotticians will look for is on a break of the wave B high. So we have A, B, and C. So a lot of Elliotticians will say, well, you can start looking to position yourself long the market if we take out the wave B high. Why is that? Because if this is a downtrend, right? I'm just going to draw a little trend channel here to emphasize that point. If this is a downtrend, then we need a series of lower highs and lower lows. But we don't get that. We stop seeing that series of lower lows and lower highs if we take out the wave B high. That's why the wave B high being taken out is a very common entry point for Elliotticians. Another common entry point would be if we make a new high above the previous impulse. So if we take out this level, that would be a more conservative entry. We're now waiting for more technical price confirmation to give us more information about what the market is doing. All right. If we take out this high, then the worst case scenario really is that we're dealing with some kind of expanded flat. So someone that's looking to enter the market on a break of this high would probably be best served to use a stop loss that's going to help them preserve the integrity of the profit factor on that potential trade because they've already taken care of the win rate. So if you're looking at, let's say we say this is a wave 1 up, this is a wave 2 down, and we're looking for wave 3 much higher, and we say that wave 3 travels at least 161.8% of wave 1, then someone that's using the most conservative entry method could potentially set up a trade that looks like this. They could have their stop all the way down just beyond the origin point of that impulse wave, and they could be looking to set their target at the 161.8% extension, Fibonacci extension. But you'll notice how this risk-reward ratio is not that favorable. Okay, so what they now have to do to get a better risk-reward ratio is to start compromising on where they place their stop. Now we get better. Now we get better. Okay, so there are 1,000,001 ways to set a risk-reward profile for a trade based on your entry and exit ideas. All right. I'm not saying that it's wrong to have a risk-reward ratio under 1-to-1. If you have a high enough win rate over time, that is a path, a mathematical path to consistent profitability. Likewise, if you have very large risk-reward ratios on average per trade and your average strike rate is a little bit lower, well, you can still be most definitely on a path to consistent profitability. I personally think that trading echoes many of the lessons found in other areas of life. And one of the key lessons that I've learned in my life is that balance and harmony are ideal. So I look to balance a higher strike rate with a medium to high risk-reward ratio. That's my goal for consistent profitability over a long period of time. So I have my own entry methods that I've tweaked in order to allow me to find that balance between strike rate and risk-reward ratio. All right, I'll give you one example, and this has to do with zigzags. So a zigzag is a 5-3-5 structure, meaning after we have our bullish impulse, we're going to have a 5-wave A, 1, 2, 3, 4, 5, followed by a 3-wave B, followed by a 5-wave C. So the most aggressive entry that I like to look for, or one of the more aggressive entries I like to look for when I'm trading a zigzag, is to enter on a break of wave 4 of wave C. Why? Because it's the same concept. It's just applied to a different scale. For a downtrend, we need to make lower lows and lower highs. The moment we take out a lower high, it can be a sign that the trend has changed. And this is where the wave principle and knowledge of the wave principle is very helpful. If I can count 5 waves down for A, 3 waves up for B, and I can count clear 5 waves down for C, then I have a high confidence objective here for bulls. If we can take out that wave 4 high, and I know that wave C is counted as complete and we're dealing with a zigzag, then I can start entering the market with confidence. Now, I usually wouldn't enter directly on a break of that wave 4 high. I'd look for a 5-wave advance. I'd look for us to take out that wave 4 high, and then I'd look for a 3-wave corrective pattern, and I will repeat the process. Now is when I'm looking to position myself in the market. So this is my first condition. All right, we need to take out that wave 4 high. My second condition is we need to do so in 5 waves. And my third condition is that the ensuing corrective decline has to be in 3 waves. All right, so that's how I like to trade. I can use the lower time frames to do that, and to take a relatively less quote unquote risky entry because I'm trading with the larger underlying trend at my back. All right. So that is my personal, what I just covered here. I can apply that to all the other Elliott Wave corrective patterns. That is essentially the basis, the foundation for my trading philosophy, right? How I look to take risk in the market. I apply this same concept to everything: triangles, flats, zigzags, combinations being the hardest pattern to trade, triangles, ending diagonals, etc. Okay, so I hope this was helpful, gave you a little bit of insight into the parallax way. We're starting to pull the curtain back a little bit more with each video, it seems. So I'm expecting some questions from this video, so let me have them, send them my way, and I look forward to talking to you guys soon.